good evening, and a very, very warm welcome to our summer edition of MFB Live. Thank you so much for joining us today, and I hope everybody has been keeping really, really well. So look, we were thinking about what content to use for this edition of MFB Live, and actually when we really thought about it, we know that limited company lending is really a subject which is at the heart of lots of landlords' thoughts at the moment. If you look at the statistics, it will tell you that 1 in every 2 landlords are now using a limited company structure to acquire buy-to-let properties. And the data that we have in terms of the clients we deal with, actually the weighting is even heavier in favour of limited company ownership. So really there has been an exponential growth in terms of limited company borrowing and applications since the announcement of Section 24. Now, despite the fact that it's really, really popular, there's lots of it going on, there's still a lot of kind of uncertainty and false understanding in the market in terms of, borrowing through a limited company, how to set one up, whether it's the right structure actually to use, if it just that's what everyone should be doing, whether it's right for the individual. And so what we wanted to do is really curate a session where we can answer lots of those questions and hopefully provide something that's really informative to you if you are thinking about using a limited company structure going forwards. So I was really delighted when Roger and Abel confirmed they would be able to come and talk to us. Both of them are really, incredibly knowledgeable people. Having said that, they're both also incredibly busy people. And so what we weren't able to do is coordinate diaries. They were both able to be here live tonight. So both the discussions that I've had with Roger and Abel happened in the last week and are pre-recorded. But look, having said that, what I can tell you, because I've had the discussions already, is they are incredible. The knowledge these guys have is amazing. And actually, I thought I knew pretty much all there was to know about limited company lending. And I can assure you, I really, really learned some stuff with these discussions. So really fantastic. So we're really excited to share these with you this evening. So look, first up is my wonderful discussion with Roger Morris. Now, having joined Precise Mortgages over 10 years ago, Roger has helped shape the sales team into the respected force that we see today. So he's now Group Distribution Director for One Savings Bank PLC, which includes Precise Mortgages, Kent Reliance for Intermediaries and Interbay Commercial. And he's responsible for driving and harnessing distribution and education. Now, this evening, he's going to be imparting his wisdom on limited company buy-to-let mortgages. Now, what I would also say is that as well as being, absolutely, a really senior person in the mortgage industry, Roger is also a landlord himself. He has a fairly substantial portfolio of buy-to-let properties. So he really does come to the table with knowledge, not just as things as from a lending perspective, but also as a landlord himself. So he's been through the same kind of processes that you guys have. So we're really incredibly privileged to have him join us this evening. And also, I might just add, he's absolutely one of my most favourite people in the industry, really charismatic, so great to listen to as well.
Roger, thanks so much for joining us today. Lovely to see you. You're looking incredibly well. So look, in terms of what One Savings Bank are seeing, are you really seeing more limited company applications than personal these days? How's the balance looking for you guys?
Yeah, Jenny, hi, and thank you for this opportunity to speak to you and to be able to support what I think is a really incredible business that I've admired for many years. When we look at how we've seen an increase in limited companies, I think we've got to go back to that George Osborne announcement in June 2015, which is commonly known as Section 24, where basically it said from April last year, landlords are unable who privately own buy-to-lets to offset any interest whatsoever. And on the risk assessment, and I always keep that risk assessment with me as a landlord for 31 years, and on page 2, it says that 4 out of 5 landlords would be unaffected. However, I think that's because they assume every landlord would take tax advice and therefore would be able to maximize, say tenants in common, for example. And because of the way companies and businesses are structured, it seems to be because limited companies can offset 100% of the interest and have the lowest ICR, we obviously are seeing a significant increase in limited company applications. I'm not at liberty to say the exact percentage, but really with our businesses across the group, the vast majority of cases are now coming inside a limited company. And that's really when you investigate it and you kind of delve into it, the landlord is really working with the centre of influence. So they've got a broker And good landlords really do value a broker. And I, as a landlord, Jenny, would only ever use a broker. I mean, I know this lender market inside out.
Yeah.
And I have some landlord friends who think they're clever enough to understand the market. But I really value a broker because you can really work out the sort of the details and the value, and work in partnership with my tax advisor. And that's the other big point I would always push is the importance of seeing a tax advisor at least once. And in most situations, it's not just about tax, but it's a long-term planning, IHT planning, succession planning of adding your children or grandchildren onto your portfolio. So the simple answer to the question, yeah, we've seen a real big increase, and that's only continued to rise of ownership of buy-to-let inside a limited company.
Yeah, and I guess based on everything that you've just said, I'm guessing that's probably a theme that you're expecting to continue going forwards.
Yeah, if you think, so if you, again, I talk as a landlord, I do have to emphasize I can't give tax advice. So if I'm expressing an opinion, it's just as a landlord of 31 years and somebody that values your advice and your experience. You know, when you've helped me in the past, you know, I've had a clear direction of what I'm going to do, and you've just shook your head and go, you don't want to do that, Rod, you want to do this. So if there's anybody watching this thinking you're an expert on buy-to-let, I'd say think again. You're better off having an informed position, but having the value of a really good broker. Brokers aren't perfect and lenders aren't perfect, but neither are landlords, but it's that center of influence. When you actually pay ultimately your tax return in January next year on your buy-to-let portfolio, I think it's then that the full impact of Section 24 will come home.
Yeah.
And for those landlords that have maybe received tax advice, you may have been advised to go from joint tenants to tenants in common. And by moving your portfolio to tenants in common, you may have been told to fill out Form 17. If that's come up in conversation and Form 17 hasn't been filled out yet because you're waiting for someone else to do it, the tax benefits do not start until that form has been filled out online. Now, it's a digital form, can't be backdated. And even I made that mistake. It cost me a lot of money. And my wife goes, Rod, you're always talking about Form 17. So I'll put my hand up. I've got an example of one here, Jenny, just for the benefit of viewers at home. It's a digital form, a digital footprint. So if you were to fill it out today, that's when the clock starts ticking, but it has to go to the revenue. And they do also want to see that trust document behind. So again, good accountancy advice, good advice and good mortgage advice. So yeah, I would expect limited companies just to carry on rising because of that ability to offset all the interest and that lowest ICR. And particularly if you're buying properties in the southeast or the more expensive parts of the UK, that just gives you more likely to get the max loan size that you are wanting at the moment. And I personally like the biggest loans I can get in my limited company portfolio, Jenny, which is different if it's in personal ownership. In that situation, I want it as low as possible.
Yeah. Actually, just going back to the tenants in common thing, and I know we're going slightly off the kind of how we sort of set this questioning out, but actually I think it's really important just from a lender's perspective. If someone is thinking about going down the route of tenants in common, as a lender, does that pose you any kind of problem?
Oh, God, no, it's the opposite. So let me give you an example, perfectly teed up. We are going off script. So, we've got Jenny, and Jenny is my wife, and she's a barrister, and Jenny's on 220 grand a year. Now, I am the husband, and I've decided I want to stay at home and look after our 3 children. So I currently have no income coming in whatsoever. So every year, I pass back my tax allowance to HMRC unused. I'm not going to go out and get a job because Jenny's going to carry on as a barrister. But what I would like, I'd like 2 buy-to-lets, both earning, say, £1,000 a month each. Now, if Jenny and I were to proceed as we used to do in the old days as joint tenants, and that first buy-to-let, that £1,000 a month rent, Jenny receives £500 and she would pay 45 pence in the pound. I would receive £500 tax-free. Now, if we've gone to see a tax advisor, statistically, I would assume a tax advisor, or what I've just said, could potentially say, why don't you do this as tenants in common? Applicant 1 would be Jenny because of the income status, and she received 1% of the rent, and she would pay 45 pence in the pound. I would receive 99% of the rent and be able to take that first buy-to-let rent tax-free because of my tax allowance.
Brilliant.
The tax advisor would have given us to Form 17. What Form 17 says, that if you're married or living together and you own a property jointly, however, the shares are divided unequally and you've got a trust document and you want to be taxed on that basis. So I want to be taxed because I receive 99% of the rent, then I would fill out this declaration. Within, my advice would be to fill it out the day of ownership, the day we buy that property, because then as long as you submit the revenue within 60 days, we can take it.
Right.
Now, from a lender's point of view, which is what you asked, when you do the advisor does the online calculation, it asks on our online calculation on private ownership, is it done as joint tenants or tenants in common? Because it's done as tenants in common, our ICR drops from around about 145 down to about 126. And the reason being is by doing it as tenants in common, it's obviously going to be more tax efficient, and most likely the tax payable on that portfolio will be very, very low, because I'm taking the income as a basic rate taxpayer. Because I'm a basic rate taxpayer, I can offset 99% of the interest, and therefore it's the most profitable, so the least risk from the lender in theory. So therefore lenders are indifferent at whether or not the property is purchased as joint tenants or tenants in common. Why? Because Jenny and I will be wholly severable liable to the debt. So I'm liable 100% of the debt, and so are you liable to 100% of the debt. So lenders do not need to know if you're going joint tenants or tenants in common, or you vary that on land reg. So you could go back retrospectively. However, you've got to be able to explain the revenue, why you would do it, because there's one big negative of doing it retrospectively, is because you significantly may pay less tax. And that might sound good, but it could be seen as tax evasion. And
which
then,
no one likes, yeah.
so from a lender point of view, lenders logically would be happy with that and wouldn't need to be explained if they understood buy-to-let properly.
Amazing, thank you. Going back on topic now, sorry for the slight deviation there. Okay, so look, as a lender, when you're looking at limited company lending versus personal, is there from a lender's perspective a kind of perceived greater risk of lending to a limited company than there is if you were lending to an individual?
No, none whatsoever. So when you lend to remember this, we don't lend to limited companies. We lend to limited company SPVs, specific purpose vehicles. And as of June 2016, when forming a limited company, you now have to put what's called a SIC code, standard industry classification. There's hundreds of them. But as long as that business has been set up for the ownership and running properties, then we're good to go. So if you and I were to form a limited company, it's purely a tax vehicle. So from a risk point of view, we know that that limited company will pay less tax than it would in individual names in theory, because of the minimum tax you would have to pay, which is corporation tax, which is at 19%.
Yep.
Next, we both would have to do personal guarantees. So we're just as liable for the debt in a limited company as we are in personal names. But the advantages could be, Jenny, is let's just say you're only young. I mean, Jenny's more like my daughter than my wife. But Jenny's just had a baby, or we've just had a baby, and that baby is called David, right? You can just see baby David with no hair smiling at us from the pram. Now, David is only a month old. Now, we might think we've got some money we would like to put into David's trust fund, and we like property. So why don't we set up a limited company SPV? You and me as directors, but David at 1 month old is 100% shareholder. And when David gets to 21, he could in effect then come on to that mortgage. We could actually come off. But again, limited companies aren't just about understanding the tax changes. It's about how we could encourage our children or grandchildren to own property. Now, David, obviously at 1 month old, couldn't sign any PGs, but as long as mum and dad or nan and granddad are happy with signing the PGs, then we're happy to do that. But the liability doesn't change in both situations. It's just a tax wrapper that the revenue understand why we're doing it, and all that's kind of upfront.
Yeah, okay, thank you. And so look, in terms of actually from a borrower's perspective, applying for a mortgage through a limited company, can they expect to see additional paperwork or checks made on them?
Not really. So what we would do is our underwriters would go to the company's house to make sure that the standard industry coding, the SIC codes, meet our requirements. So precise mortgage is very specific. There's 3. At Kent Reliance, for intermediaries and for Intermediary commercial, we're a lot more relaxed about the SIC codes. So as long as the SIC codes meet our requirements, we're great. I think the only time where there's a little bit of works is actually a positive point, Jenny. So let's just say we have Roger and Jenny's electrical trading business. So me and Jenny, what we do is we're electrical wholesalers, and we do commercial installations. And Jenny and I have had been a lot of success, and we've got about £900,000 of just spare liquid assets. Jenny says to me, Rog, we haven't got a pension. We need to get a pension. So what we think about doing is buying property, because we know everyone in the trade. Now, if we take that money out of our accounts, we're going to have to pay a lot of tax on it. Now, if we buy it in our trading business, what happens in the future if we sell that business, the business goes bust, or the fact we have to keep that business open for the rest of our life is a liability. So what could you do? Well, potentially what you could do is me and you could set up an SPV for the ownership of those buy-to-let. The shareholding is an absolute mirror of our trading business. So it's Roger and Jenny hold the trading business, Roger and Jenny hold the SPV. And then what you can do is what's called an intercompany loan. It has to run for more than 12 months. On average, it's 30 or 40 years. There's a standard template that your accountant can give you. Right. And there must be an average notional interest rate charge set by the revenue every April. At the moment, that's 2.25%. Most loans don't have a monthly repayment, just an end day repayment. And we're happy to take that as the deposit. So you and I, Jenny, could maybe put 100 grand into an SPV, and that might be a deposit for, say, 5 buy-to-lets. And that's an added advantage. There's a little bit of extra paperwork on that. And that's not something you would do in personal names, because in personal names, you just put money into as deposit. But this is a cleverer way of which your loan actually is interest bearing. So it's win-win. So
sounds
I think
great.
That's another positive bit. Yeah.
Okay, thank you. I'm liking all these new lives that I've got, by the way. I'm a barrister. I've got 100 grand in the bank. I prefer those to the current one. And in terms of other things, I suppose, that people need to watch out for when they're applying for limited company mortgages. So one of the things that I think comes as a surprise to people sometimes is if they have to get ILA, independent legal advice. People aren't necessarily prepared for that. I mean, what is that, and what other things might borrowers come across they hadn't come across borrowing personally?
Yeah, listen, we often hear, first of all, it costs a lot more to do a limited company's return than your personal return. And unfortunately, I'm not trying to be regionalised here, but southern accountancies might put up your fees for doing a tax return on a limited company because they're based in the south, but you can get accountants based in the north, northeast, northwest. My accountant charged me £40 more for doing my limited company return and than doing personal returns. So I would just say, if somebody's trying to put your cost of doing your returns, because you keep your spreadsheet, you know, and really in one property limited company, you've got your interest, you've got your repairs, you've got your letting agency costs. You can do it in a spreadsheet, send it across, it's easy to do.
Yeah.
But when it comes to when the Chancellor made the rules, and an interest company can offset the interest, and limited company SPVs have a benefit, not in every situation, I might add. There's lots of situations where you can argue personal ownership is better. So there isn't one answer. However, if you do decide to take a loan out in a limited company and PGs are required, you've got to get independent legal advice.
Yeah.
And that is down to having a lawyer that has the ability to be able to give that independent legal advice cost effectively and cheaply. Some of them will literally fleece you for £600 per. And if you're buying 10 properties, you might have to do 10 of those fee charges. So what you want to do is make sure that you look for a legal practice that can offer that as a comprehensive package. and be able to do a deal on that. Because it's all right saying, well, in personal names, you don't have to do it, but limited companies, you do have to do it. And it is just something to look out for. But like all things in a limited company like this, it is tax deductible. And once you've done it once, then you are in. And it is something we are trying as an industry to simplify, but it's limited company house rules.
Yeah, that makes sense. And I think if you listen to the context of ILA and why it's important, I think there have been times where, say, to use your example, we had applied for a limited company mortgage. I had signed the ILA but not really understood what it was, or sorry, the personal guarantee and not understood what it was. There's been a repossession situation. I've been able to go to the court and say, well, I had no idea what this personal guarantee was. I didn't understand it. And it's actually stopped the lender being able to make good on the PG. So that's why we need ILA, just to make sure that everyone understands what they're letting themselves in for, basically. So there is a context behind it. So, okay. And I look, in terms of pricing, so OSB do not differentiate on pricing between limited company and personal borrowing, but there are other lenders that do this, and I can only presume that that's because they perceive the risk differently between the two entities. What do you think about that?
The best example is there's other mortgage brokers out there, Jenny, equal to you. They are mortgage brokers, but there is a difference in the quality of the advice they give. Within your DNA and years of experience is understanding the buy-to-let market, and you can evaluate the difference between owning buy-to-lets in personal limited company names. Your advice cost doesn't go up because you understand what you're doing. And I think that's a great analogy with the lenders that put the prices up, is they don't really understand buy-to-lets, and they have to charge more because their systems and procedures are not automated. With us, it's a system, an option, and it's down to you to pick which you want, and we won't price more. Where we sit in the market is that higher LTVs. And it's about understanding that the higher LTVs, the rates are and the risks are equal. And if you're looking for the best rates in the market, it is in fact in personal ownership, and it's at the lower LTVs. Once you go below 60%, and that's why we're seeing some landlords with private ownership who want to beat the effects of the interest relief removal, are using savings, which they're getting very poor returns, to reduce the loan amount, which makes it easy for you, Jenny, to search the good deals maybe at 59.99%. Sometimes you know if you're 65%, it's worth putting a couple of £1,000 just to bring you down below a threshold to get better deals. And again, this is what a mortgage broker like yourself, I know that was one you told me on a deal with a big mutual lender that was offering a deal, and you were saying, Roger, if you put 300 quid in, you drop down into the next bracket, it's 59.9%, and that would save me X. So again, this is the value of you as a broker. But no, why lenders charge differentiation is just down to confidence and experience, which is why we have a neutral pricing.
Perfect, thank you. And so look, if someone who is watching us now is considering whether to use limited company or personal, is there any advice? Obviously, you come from a position of experience both as a lender and also a landlord. So, what would you like to say to these people?
There's only one thing I would say: see a tax advisor. See a tax advisor. More than 50% of landlords never receive any tax advice. And when and I've just referred to this very new document, and it says on page 2, the risk assessment is 4 to 5 people be unaffected by this change. The level, I think it's a bit of a revenue smile, because they just know landlords don't, on average, take tax advice, and therefore going to miss the most obvious ways to make their buy-to-let profitable. That one piece of advice will make the difference within a month of that profitability of a buy-to-let you may have for 35 years. So when considering the purchase and when understanding whether you're buying personal names or limited company, do not go to an accountant, because the vast majority of accountants are not qualified to give tax advice. Don't go to a lollipop lady, and don't go to a mortgage advisor. Go to a tax advisor. They're the only person who can give that specific advice. There is the odd accountant who's gone on and taken that extra exam, but they normally don't like to do that because it muddies the water. See a tax advisor, but explain your history, how long you're going to own the buy-to-lets for. Really understand that, how many more you're going to buy, how much you're going to earn, and what is your inheritance tax position, because old age creeps up on you. Once you've got that advice, once you've got clear direction, then you can go back to a mortgage advisor. And the one thing I would say, Jenny, is I value a mortgage advisor. And if you look statistically, the group of landlords who use mortgage advisors the most are the experienced landlords. So what does that tell you? You learn your mistakes, you wish you'd use an advisor, and then you value them.
Yeah, thank you. I think what we definitely see with some of our, well, lots of our clients actually, particularly those with the larger portfolios, and you're absolutely right, is they have a team of people around them, which is their mortgage broker, their tax advisor, they have solicitors that they work really well with, in the same way that a property developer has a team of people, landlords who are investing, effectively have these people too. So look, my last question for you, and I think this is kind of on everyone's minds at the moment, but what are your thoughts about the buy-to-let market over the coming 12 months? Time to get your crystal ball out, Roger.
Yeah, well, my portfolio is based in the northeast of England, which has seen the first value property rises since 2004.
Oh.
So I'm really delighted on that. We've seen some really big growths. And the other area which I've been buying and developing in is Birmingham.
Right.
And I've been living here for 3 years. Now, at the moment, when I bid for a property in Birmingham and Teesside, I just lose out because first-time buyers and movers, there's 9 offers going in, and I just don't want to be facing that sort of competition. However, the negative effects of what we've seen with the price increases, and once stamp duty ends, potentially by October, when the market settles, a lot of first-time buyers may have actually priced themselves out the market. And we do know one of the other negatives of COVID is the massive increase in divorce rates. And what I am seeing is an unprecedented demand for the buy-to-lets that I do have to rent out. So I think if we wait till the market settles, stamp duty ends, and we see everyone returning back to work and see where property prices actually drop to, I'd be looking at buying properties with an EPC rating of an F, so I can actually buy where they're not in a lettable state. I would refurbish them, and I would then exit onto a term buy-to-let product for 35 years on the increased value. That's what I'm looking. And when I'm doing the refurb, Jenny, I would make sure that the EPC rating was a C, because
Yes.
new tenancies need to be on a C rating by April 2025. So I'm keeping one eye on that. And if I'm going to look at a property now that I can't cost effectively get to a C rating, then I'm not going to buy those properties. So I'm actually looking at newer properties now more than the conventional terrace Victorian property that I've bought in the past. So wait is my opinion, unless you're in an area that isn't too competitive. Yeah. But just don't pay over the odds for the sake of the market is cooling at the moment. And I think you'll see lenders' rates, criteria and opportunities become significantly better for landlords in that last quarter of the year. And number one piece of advice, use Jenny and Mortgages for Business. Value your book.
Thank you, Roger. That is brilliant advice, and everything you said today has been really, really super informative. I really appreciate you taking your time. You're like the busiest person that I know in the industry, so genuinely thank you for joining us today.
No, thank you, and thanks guys for watching. Take care.
Wasn't he wonderful? What a fantastic conversation. I hope you find that really useful. Excuse me. Now, next, I'm delighted to share the conversation that I had with Abel Asiamah, who's a senior tax manager at Alexander Rosse, which is a chartered accountancy firm. Now, Abel is a fully qualified chartered certified accountant with nearly 20 years of experience in the SME sector. Now, having been with Alexander Rosse for more than a decade, Abel is definitely an expert on corporate and personal tax matters. His extensive experience means he has the thorough understanding of the issues which are important to landlords, limited companies, property businesses and more. Now, look, I think it's fair to say that when we're speaking to our clients, when they're considering the options of whether to use a limited company or invest personally, we're always saying to them that you really need to go and speak to a tax advisor. Tax advice is absolutely key. And I know that Roger in the previous interview also really reiterated this point. So like I said, we were incredibly grateful to be able to have Abel come and join us. And it's a really, really great conversation.
Abel, thank you so much for joining us today. We really appreciate you taking time to come and really inform our viewers about the situation with Section 24. So, Abel, to kick things off, please could you just give us a summary of what Section 24 actually is and how the changes have impacted landlords?
Yeah, excellent. Thanks for having us. We appreciate the opportunity. Yeah, so Section 24 has been with us for nearly 4 years now. And in terms of the main impacts of that law, it's essentially it was introduced to enable the government, in effective terms, recuperate more tax, curb the property rises in the buy-to-let market, increase the property stock available for new buyers. In terms of its impact on landlords, it's been that landlords are having to pay more taxes in effect. And this has come about as a result of restriction of mortgage interest or finance cost available for landlords in terms of deductions from their rental income. So the net effect is landlords are having to pay more taxes and when they file their tax returns and what have you. So I would say the gross impact is they're having to pay more taxes and due to restriction of mortgage interest.
Okay, thank you. And so in terms of landlords who are concerned about this, I'm guessing we know that there are options for them in terms of other structures. So perhaps you could just talk us through some of those structures just now, please.
Yeah, sure. Thanks for that. It's a very good question. In terms of obviously the options available, most landlords find themselves in a situation where they own a buy-to-let business, which are mostly unincorporated, i.e., it's they operate on a sole trader basis, or in some cases a partnership. Most landlords didn't think about this in the long term and haven't set up corporate structures. In terms of the options available, those who currently have their properties located or incorporated in a limited company would obviously continue to do so because that is the most, should I say, most tax efficient avenue. In that most limited companies are still allowed to deduct interest from their rental income. For landlords who find themselves in a situation where they are still a property business or an unincorporated entity, there are a few options out there they could potentially look at. One of the options would be potentially getting a partner involved, i.e., could be a wife or a family member who is on a lower income, and thereby spreading, should I say, the income to avoid the high rate impacts on the law from the law. The other options would potentially be to move your portfolio from a residential portfolio to, let's say, a commercial portfolio. In that most commercial properties, you're still allowed to deduct interest, as the case may be. There's also another option. You could potentially set up your own property management company. And what that literally entails is you'd be in a position whereby you'd be able to, should I say, scoop up some of the profit that would have ended up being taxed on you as a sole trader into that management company. And then, of course, pay corporation tax on that profit.
Right.
Another option, which I'm sure we've all heard of, is known as the rent-to-rent option, where typically people come in, and this more especially for HMO landlords. The way it works is literally you could set up your own rent-to-rent company and then lease out all your properties on a single let basis to the rent-to-rent company. The rent company then obviously manages your property as a HMO. The difference between the rent-to-rent option and the management option is that you'd be able to obviously charge a higher management fee, as there are limits to how much you can charge as a pure management company. That with a rent option, you'd be taking on a lot more responsibility. So that way, you'd be able to take a larger chunk of that profit into a limited company setting. The other option, which obviously it's a little bit controversial, but most property businesses are now using it, is the obviously beneficial interest company trust, which essentially means you would literally pass on the beneficial ownership of your company to a new limited company. And that limited company declares the rental income, pays you the mortgage interest, and then, of course, most of the profits are ultimately moved away from you into a limited company. So, in summary, these are some of the options available to landlords who are potentially find themselves in this situation.
Sure, thank you. And I think really what I would say at this point is that there's obviously lots of options. So getting really good advice from a tax advisor is really important. And
Definitely.
interestingly, when you mentioned the beneficial interest company trust structures,
Yeah.
because I know that accountants and tax advisors think they're very, very good, but mortgage lenders really don't like them. So we've got
There are
clients.
issues.
Yeah,
Yes, there are potential issues with it. Obviously, it's still very new, and it's untested. We don't know HMRC's view on it ultimately, and I suspect from a lending perspective, there are issues already.
yeah,
But
yeah,
I feel every situation would have its own solution. So it would very much be a function of your own personal situations. There are clients we've advised in the past who had probably 1 or 2 properties, and we've advised them to just keep them in their names. Others who have plans of setting up larger portfolios, you're well advised to start using a limited company. And those who want to incorporate, i.e., move everything from their existing sole tradership business into a limited company structure. So every situation, every solution would demand obviously a specific investigation into the affairs of that individual to
yeah.
recommend suitable advice.
Yeah, I think that's absolutely key, isn't it? It's speak to a tax advisor, but also then speak to a mortgage broker and make
Definitely.
sure that the two marry up and it works in the round rather than just focusing on tax or mortgages. And so moving
Exactly.
sort of more specifically onto limited company structures. So
Yeah.
as a business, we're seeing we have seen a huge swing in terms of the number of people using corporate structures to acquire property. That's reflected
Exactly.
across the whole market. So perhaps it would be really great if you could just explain to us first of all, how you're actually taxed when you use a limited company for your investments.
Yeah, excellent question. So we all know what's happening now. People obviously moving away from sole tradership type of structure as far as their property business is concerned. With the limited company structure, the main attraction here is most limited companies are taxed, or small limited companies are taxed at 19%. So, and the main advantage here is you're able to deduct your mortgage interest. So strangely, the government decided it would only apply to individuals and not to limited companies. So the long short is you'd obviously prepare your accounts, pay your corporation tax returns. The company would show a profit, and that profit will be as a result of deduction of mortgage interest from your rental income. Whatever profits you end up in that company, you'll be taxed at 19%, depending on the size of the company. But for most small businesses, it's 19% of the property income.
That's corporation tax,
That's
yeah?
corporation tax, exactly. The advantage here for corporation tax, for you running your business to a limited company, is unlike your sole tradership structure. If you don't personally draw money out from that business, you won't suffer any personal income tax liability. So that is the main. There are significant tax advantages with going to a limited company. It offers what is known as a tax sheltering. So, for instance, if you were already employed elsewhere with significant amounts of income, and you are running your property business through a limited company, you offer that opportunity not to get taxed on every single penny as you would have been if you were running a sole tradership type of structure. So there are significant tax advantages. If you don't actually personally take any money out from the business, you won't suffer any income tax, even though the company bears corporation tax rate, but that will be at a significantly lower rate of tax, i.e. 90%, compared to what you would have paid at 40% or 20%, as the case may be.
Perfect, thank you. That's a good explanation. And I suppose that really leads me on to 2 questions. So first of all, using the limited company sounds really positive. I mean, is there any cons to using it? Is there any downsides?
Unfortunately, there are. And it's always a function of your personal, as we've already indicated, it's always a function of your personal situation and your circumstances. Let me put it that way. This structure might not be suitable to every single type of business. So to give you an example, if for instance you had 1 or 2 properties, you didn't have any other source of income, and your properties were your main source of income, generally our recommendation would be there's no point in incorporating. I run your property through a business, a limited company. There are, you probably back me up on this. When it comes to limited company mortgages, the interest rates are much higher than going for a mortgage personally.
Yep.
The borrowing costs are much higher. You do tend to get higher LTVs, but it comes at a higher interest rate. There is compliance cost with running a limited company. So what I mean by that is with a sole trader type of business or unincorporated type of business, there's in terms of the compliance requirement with Companies House and HMRC, it's very low. However, with a limited company, you would have to file your corporation tax return, the annual accounts, confirmation statements, and it's a whole raft of legislation, especially from the Companies House perspective. So the compliance burden is slightly much higher.
Yeah.
It's not a relaxed regime, unlike the unincorporated entities. There are also there's a potential for double taxation. So what I mean by that is obviously any income earned by the limited company in the form of profits will be subject to corporation tax. In the same vein, if you then take money out from that company, you would end up with income tax liability as well. Right. So depending on your situation, some cases, if the plan is not to take money out and then you'd only use as a retirement fund of some sort, it works brilliantly. On the other hand, if you were in a situation whereby you're already a higher rate taxpayer and you draw money out in the form of income, that double hit could be potentially not tax efficient. There are other things like capital gains tax. So in a limited company, if you sold your property, typically you'd pay corporation tax at 19%. And then, of course, those funds will be in the limited company. So to take those monies out, you'd end up with another form of tax. Depending on how you take the money out, if you take it as a dividend, it's income tax. If you take it out as a capital gain, you're going to end up with the tax rates, either 10%, 18%, or whatever, depending on your marginal tax rates. So it's not, it's really a function of your individual circumstances. But generally, it offers a higher tax efficiency, compared to the sole tradership or unincorporated structure.
Thank you.
Especially with this new regime of Section 24.
Thank you. And the other question, which you've kind of touched on already, is that in terms of getting money out of the limited company, so, I've got my limited company, I've built up a nice amount of, of cash in there, I want to have some of it out. How would I access that? And what are the tax implications of that as well, please?
Yeah, that's awesome. That's a good question. So in terms of taking monies out from your limited company, there are a few options. Typically, if you did incorporate your property business, so for instance, moved it from your existing structure, in most cases, you'd end up with what is known as a loan account. And it's essentially all the equity you have in your property, you'd literally lend it to the company. So most incorporated property business, or even those running it through, setting up their own property businesses and running it through, most of their deposits are self-funded. So you're typically going to end up in a situation whereby you've got a large chunky loan account in the limited company. If you find yourself in that situation, drawing down that loan is not taxable. So it's essentially a loan repayment from your company to yourself. So it could be one means of obviously taking money out from the business. The other option will be dividends. So dividends, typically, it's obviously a return on your investment. So as a business owner, the company can pay you a dividend. Dividends are fantastic in the sense that there's no national insurance when you draw dividends from your business, unlike other forms of income like salaries and bonuses. There's no national insurance on dividend, and that's the main attraction with dividends. They also have a tax-free allowance of £2,000. So regardless of your rate of tax, you can draw out a dividend. The tax rates on dividends are quite low as well. The first 2,000 is tax-free. Then the next 37.5% comes in at 7.5%, and then you go into 32.5%, and then if you're an additional rate taxpayer, it goes on and on, basically about 38.11%. So dividend offers quite. You could obviously take a salary, but again, these are a function of your individual personal tax circumstance. If you're already in a high income employment, perhaps you might not need the sum and you could leave it for when you retire, in which case, when you retire, your source of income would probably be nil. If you've got some pensions and some other forms of income, generally your tax rates will be lower. At which point, if you've got an accumulated amount of cash in the business, you can obviously take it out and suffer a much lower tax rate.
The director's loan, the director's loan account. So say I bought a buy-to-let, I put some money into my limited company from my own personal reserves and set up a director's loan account to do so. Is there a restricted amount of time for me to be able to draw that money out, or is it as long as the company is in existence and it owes me that money, I can take it back?
Yeah, so there's no restriction. So it's essentially you've lent X amount of money to your business, and it's up to you when the business pays that money back to you. So there isn't any time restriction on it.
Okay, perfect. Thank you. And so look, the other thing we're seeing lots of at the moment is incorporation. So the process where someone moves property from their personal names into their limited companies. Is there, could you possibly explain to us the process and also the tax implications of doing so? And I know there are different ways of potentially making this transaction happen as well. So if you could just talk us through that. Great, thank you.
Yeah, I think that this one here is quite a big topic, and yeah. So what's happening is obviously people have found themselves in this situation, and most of them are literally turning their sole tradership on incorporated businesses into a limited company. In terms of the meaning of that transaction is literally what you're doing is you're selling your properties to a limited company. So in the same way as you would see Mr. B and Mr. B wants to buy a property and you go in there and sell that property to Mr. B, is the same way. The limited companies are different legal entities or different legal personalities. So they are not literally you're two separate entities. So when you pass on your properties into a limited company structure, you're effectively selling that property to a limited company. And that is known as incorporation in tax law. So to that effect, if you dispose of a property to a limited company, you would end up with capital gains tax. If the limited company acquires that property from you, the limited company would have to pay stamp duty. So effectively, if you do incorporate, what you're effectively doing is you'd end up with these two taxes. The good thing, however, with incorporation is there is something known as the incorporation relief. And what that literally means is the government would say that you owe me capital gains tax now. However, I wouldn't collect the capital gains tax. I'll defer it until such point as you sell the underlying shares you'd acquired on incorporation. So that's one of the main advantages. However, to secure incorporation relief, whatever that entity you have at the moment is, it needs to be a business. It needs to be a property business. So it shouldn't be a passive type of operation. So for instance, if you had one or two residential properties, single let occupancy type of property, which is a very, very passive way of business, I would say, you would have a hard time getting HMRC, trying to convince HMRC that it's a property business. So typically, it's more for slightly larger portfolios and HMO type of business where there's a lot of time involved in managing those portfolios. In those situations, you could potentially secure incorporation relief and then, of course, avoid capital gains tax. When it comes to stamp duty, it's different. The stamp duty is not a function of the type of business. It's really more to do with how that transaction is carried out. So typically, if you run a property, if a partnership disposes of assets to a limited company, there is no stamp duty. So what most people tend to do in the form of planning would be to rather start from a property business, go to an LP structure, and then from the LP structure, go to a limited company structure. So if you go through those forms of these structures, you would end up in a situation whereby you'd avoid stamp duty and, of course, defer capital gains tax. So it's a bit of there are a few steps involved, but if it's done efficiently, you could potentially save yourself those two taxes, which tend to be the major issues. Of course, there are issues. Then you've got other issues with obviously your mortgages, moving lenders, or what have you. But I suppose that's your territory. But yeah.
Thank you. Yeah, I mean, we're seeing lots of our clients going through the process where they're looking to take incorporation relief, and I cannot really emphasize enough how important it is to do it properly and get really good advice. One bit of missing paperwork can be the difference between paying capital gains and not paying it, or it being deferred,
which could be significant as well.
Yeah, absolutely. Abel, I'm out of questions. Thank you so much for
Brilliant.
your help. I've really actually enjoyed listening to everything you've got to say. It's been really useful. I'm sure everyone
Thanks for
watching
having
has
us as
found it
well.
too as well. Yeah, no, thank you so much for your time.
Appreciate it. Thank you very much.
Thanks.
And there we go, another wonderful conversation. Abel clearly really knows his stuff. And like I said before his chat, I learnt so much there. So thank you so much to Abel and to Roger for sparing the time to come and talk to us. We really do appreciate it. And I'm sure you guys watching this will have found this, their input incredibly useful. Now, as I mentioned at the start of this, we have had a huge number of questions emailed in anticipation of our event. Over 80 questions, and I'm simply not going to be able to go through all of them today. So what we've done is we've particularly picked out those questions which are predominantly relevant to limited company lending, because that's what we're talking about today. I can't answer any questions around tax. So what we're going to do is try and hook the people who emailed in regarding particular tax questions directly up with Abel, and any other kind of more specific mortgage related questions we're going to ask one of our consultants to contact you and advise you directly. So let's start off with some of the Q&As, and there were some amazing questions, I have to say, so thank you everybody for sending them in. We do appreciate you doing so. So the first question we've been asked is the rental market finished? Is there going to be a crash? And where do we see property prices in the next 10 years? Look, I don't think the rental market is finished by any stretch of the imagination. Indeed, when we look at the data, the demand for rental properties is increasing, landlord confidence is increasing, rental yields are increasing. So I don't feel that the rental market is finished by any stretch of the imagination. However, what I would say is there's definitely an element of dissent amongst landlords at the moment. I think, and I'm a landlord myself, right? So I really do understand this, and I speak from a position of empathy. Things feel like they're always changing in against the landlord. So the tax situations, the regulation, the right to rent rules, it just goes on and on, and so I think there are a lot of landlords who are probably a bit hacked off at the moment. There are also many landlords who recognise that this is a business, and with all businesses, every type of business is getting more regulated as time goes on. It's not just landlords. And I think, actually there's loads of landlords who are still very, very happy to be a part of the market. So I think really, in short, I don't think the rental market is finished. I think there's going to continue to be a huge demand for it. I do think some landlords may just bow out of it, but I also think that will just make way for new landlords to come in. We're still speaking to landlords who are new to the market and who are really keen to get involved because they recognise, or feel that it's a great thing to be in. In terms of property prices in the next 10 years, I think we're expecting prices to continue to rise for the rest of this year, not at the rate that they've been going up in the first half of 2021, but we do expect them to continue to increase. There is a concern about what's going to happen with property prices as we move into 2022. My suspicion is they're not going to tank. You may see some regional variations, so some areas will probably hold their own better than others. There may be some decline in prices possibly going negative, but negative from today, not negative from 6 months ago. But I do think actually prices are going to hold firm. Why do I think that's going to be the case? Because there's lots of people who are still adjusting the way that they want to live. They're adjusting to their new working arrangements. There's not enough housing. There's a shortage of housing stock. That's not going to be corrected in the next 10 years. So genuinely, I do believe that house prices are going to hold firm and go up over the next 10 years. By how much, it's impossible to say, but I hope that helps. Now, the next question we've had is, can I get limited company mortgages without using a broker? What is the maximum number of buy-to-let properties a limited company would be able to purchase through mortgages? So sort of two questions in one there. So the first one, can I get limited company mortgages without using a broker? Yes, there are limited company lenders who have a direct, offering, so you can approach them directly. Obviously, we'd much prefer you to use a broker, ideally us. But, there are some lenders. There are also quite a lot of lenders in the specialist end of the market who do not accept direct business. And the reason for that is these guys tend to be smaller lenders. They have a fairly limited number of resource within their offices. And what lenders do find is when business comes in direct from the borrower versus direct from the broker, the quality of the business is much less, not because they're bad borrowers, but they just don't tend to fit criteria. So it's quite an inefficient way for lenders to accept business. For these guys, they recognise that actually, taking business from a broker is much better for them because it really, gets them a better quality of business. It's much more efficient for them, which is great. I mean, even if you look at one of the really large Goliath lenders, high street lenders like Santander, the majority of their business still comes in through brokerages. In terms of the maximum number of buy-to-let properties you can have through a limited company with mortgages, the honest answer is there is no limit. We have clients with just 1 or 2 properties in a limited company getting mortgages. We have clients who have hundreds of properties in a limited company and they're able to get mortgages. I think if you had a really sort of large portfolio of maybe, sort of more than 30 properties, you'll probably start to find your choice of lenders starts to diminish because every lender will say, we're willing to lend any one kind of lending entity, so person or company, a maximum of say £3 million. So eventually you just hit an exposure limit with that lender. So we have got some clients who have used up most of their limits with most of the lenders now, and that's when it can start to get a bit sticky. But short answer is there's no limit. Excuse me. Okay, I left my full-time job around 18 months ago. I was on a good salary, but now only have buy-to-let income through our limited company and outside the company. Will getting a new buy-to-let mortgage through the limited company be a problem for a new property? So what we've got here is someone essentially whose income is solely driven from buy-to-let rental income. Yes, absolutely, you can still get a buy-to-let mortgage, particularly in the limited company space because of the kinds of lenders who are lending to limited companies. These guys are incredibly landlord friendly. They don't mind that you don't have kind of a job income that's not buy-to-let related. You won't have any problems, honestly, that's absolutely fine. Excuse me. Okay, next question. I have 2 companies for different business purposes. Can I have intercompany loans to help with purchasing a property? Would there be any tax implications to consider, and what would this affect the mortgage application? Okay, so intercompany loans falls under the sort of category of deposit monies, and we've got lots and lots of information on our website regarding this. But essentially you would have your sort of business day job trading company, and then you'd have the SPV company that you'd want to borrow through and acquire the mortgages through. Yes, you can do an intercompany loan from one company to another. Not every lender accepts these, but there are still a fair number that do, and some of the kind of more more prolific, larger limited company lenders will do. Precise Mortgages, where Roger works, would be one of those as an example for you. In terms of the tax implications, I'm sorry, I really can't answer any tax related issues, but I hope it helps to know that, from a mortgage perspective at least, intercompany loans are absolutely fine for some lenders. Okay, now we've been asked, how do lenders perceive LLPs? Do LLPs have any tax or trading advantages over limited companies? So in terms of LLPs, lenders will treat LLP applications the same as limited company applications, with a slight twist. So if you have an LLP, you can get a mortgage, don't worry, there are lots of lenders who will lend to you. It's limited company rates and products rather than personally owned rates and products. Now, the only thing to be wary of here is that with an LLP, the income is a partnership. So people are declaring the profit from the partnership as personal income, not as company profit. So when we're doing the rental calculation, how much can I borrow per pound of rental income? The lenders are going to treat the application as if it was personal names, i.e. the more sort of conservative rental calculation, rather than limited company, because the way the taxation works for LLPs is like personal taxation rather than company taxation, so just to be aware of that. In terms of trading advantages, look, if you are thinking about using any kind of corporate structure, the best thing to go and speak to a tax advisor who'll be able to kind of run through the pros and cons for you. Okay. Our next question, with stamp duty going up again, is buying through a limited company still a good investment? Yes, it is. Of course it is. In the long term, of course, we hope, and I'm sure that they will, the house prices will go up, the rental income will go up. It's going to be a really good long-term investment for you. I think it's fair to say that, look, being a landlord investing in property, it's a business, and every business will make decisions based on calculations, financial calculations. So when you're looking at acquiring a property, the stamp duty cost is simply a cost of acquisition in the same way that you're going to pay for evaluation, you're going to pay for, I don't know, EPCs, you're going to pay for the conveyancing process for buying the property. And the stamp duty is simply another cost. Now, when you put all of those costs together, the numbers will either make sense for you or they will not make sense for you. And that's going to be really specific to each individual property, okay? So I think, yes, it's still a very, very good investment, but ultimately you need to kind of do your homework, really look at all the numbers involved, all of the costs, not just the stamp duty, and make sure that it really makes sense for you. In terms of what making sense looks like and what good looks like, that's a very, very personal thing. Some landlords have a real kind of baseline in terms of their expectations on the property. So they'll only buy a property where the yield sits at a certain, say 5%, 4%, something like this. Other landlords, it's more about, actually, I recognise that this property is an area where I genuinely feel there's going to be a good growth, capital growth over the next 5 years. So I'm buying it not because I think the income's going to be fantastic, but actually because I really do believe I'm going to see an increase in capital value. So, really very much a kind of case by case basis there. Okay, we've had a question which is, if I own a house outright and I have no mortgage, can I sell it to my company and take out the equity? I will of course be renting it out and not living in it. Now that raises a very good point and something we get asked quite often, which is, can I own a property in a limited company with a mortgage and live in it? And the very short answer is that no, there are no lenders at the moment who actually allow this, which is a cause of frustration for some people, but fundamentally you can't do it. But to answer the question that we've been given here, so yeah, absolutely. When you sell the property to the limited company, you can borrow potentially 80% of the property value as mortgage, which would then come back to you and essentially end up as cash in your pocket. The difference between the loan amount and the purchase price, and we're going to come on to this in a bit more detail in a moment, would remain as equity in the property, and that would be kind of documented as a director's loan, which Abel and I touched on earlier. So I hope that helps. We've had quite a lot of questions about transferring personally owned property into a limited company and what the process is. Now, again, Abel and I have touched on this already today. But essentially, I think the really key point here is people often come to us and say, I want to remortgage my buy-to-let into a limited company. And it's really important that we use the correct terminology here. It's not a remortgage. A remortgage is where you take a property that you already own and put a mortgage on it, or replace a mortgage that you've already got with another mortgage, but the ownership of the property would remain, yours. When you move a property to a limited company, the limited company is a separate legal entity to you, so that it is always treated as a purchase, not as a remortgage. And so the easiest way to kind of get your head around how the logistics work is if you totally separate yourself as the seller and the limited company as you. So let's give an example. I have a buy-to-let in my own name. It's worth £100,000. I'm going to sell it to my limited company. The mortgage on my property is £50,000 at the moment. So what will happen is the limited company will pay £100,000 for the property. One thing that's really important is you need to pay a fair market value for the property because otherwise it's classed as tax evasion, basically, and none of us want to be doing that. So £100,000 purchase price. I'm going to raise a mortgage through my limited company of 75% loan to value, which is £75,000. So on the day of completion, we don't pay 10% deposits on exchange of contracts. We don't need to do all of that, but on exchange and completion will happen simultaneously. So what happens is property ownership goes to limited company. Limited company has a mortgage of £75,000, which then comes back to my solicitor. My solicitor will take the £75,000, £50,000 will go to clear off my existing mortgage. The other £25,000 comes to me as cash. The £25,000 that stays in the property, the equity, which is essentially the deposit money, is made up as what's called a director's loan from myself to the limited company, okay? And that's where the deposit comes from. All of this happens sort of simultaneously. It's a paper exercise. A good solicitor can sort this out for you. It's really not as complicated as it sounds, but that's the kind of logistics of how the steps work. And we've talked about director's loans previously this evening, and we've kind of covered off the benefits of those. So I hope that explains it. It might be one where you want to give us a call and we can kind of go through it step by step individually. Our last question for this evening is, I want to purchase my first buy-to-let property. I would like to secure a mortgage before looking for a property. Please advise. Okay, what we cannot do is obtain a mortgage offer prior to you finding a property. A mortgage offer is a really legally binding document where the lender says that I agree to lend you X amount of money on these terms secured against this specific property. And the mortgage offer will have been produced because the lender is comfortable that the property is good security because a valuer has been out and visited it. So obviously, if you haven't actually found a property, haven't even started looking, the reality is that we're not going to be able to obtain a mortgage offer. However, there is lots of work that can happen before that point, before you go and view properties, to give you, real confidence that when it comes to the point of looking to go and visit properties and make offers on them, that you should be okay to get the money. So what we do at Mortgages for Businesses, when someone comes to us with a new inquiry, what we do is we'll have a chat, find out more about our client, their financial situation, what they're looking to do, and then also about the property that they're going to look to acquire, or the kinds of properties that they're looking to acquire. We'll then go off and do some research. We'll look at the whole of the mortgage market, try and figure out which of the rates on offer is going to be the most appropriate for the client, both in terms of its competitiveness and also the kind of features that sit around the mortgage product itself. So, do you want a 2-year fixed or a 5-year fixed? Do you want to be able to make overpayments? All that kind of stuff. Assuming our client is happy with what we've come back with, they will then fill out an application form. And with that information on that form, we can obtain what's called a mortgage agreement in principle. Now, this is where we go to the lender and we say, this is Jeni Browne. She's a, mortgage broker. She wants to buy a buy-to-let property. This is how much she earns. She has her own home. It's worth this. This is her residential mortgage. She has a car on finance and 2 buy-to-lets in the background. Would you lend to her? The lender will take that information, run a credit search on me, and, hopefully come back saying, yeah, in principle, we're happy to lend Jeni the money to go and buy a buy-to-let property. And this really is as far as we can get without having a specific property in mind. But actually, this is as much as you probably need to know, because what you have here is enough information to understand that you're creditworthy for the mortgage, and that actually you understand the terms that sit around the mortgage in terms of the cost involved as well. So lots of work that can happen beforehand to give you some real comfort. I do hope that helps. So that is everything from us this evening. Thank you so much for joining us. Like I say, I really thoroughly enjoyed my conversations with Roger and Abel. Really fascinating and informative. Just goes to show I've been doing mortgages for 20 years now, and every day is still a school day. We'll be back with another MFB Live in the autumn. If there is anything people watching this would love to hear about, we're always open to suggestions. Obviously, these sessions are really designed to help you and inform you. So if there is something you'd like to hear about, do let us know. We're very, very open to kind of trying to shape these sessions to make them as useful and informative to the people watching them as we possibly can. Until next edition in the autumn, please do look after yourselves. If you have any questions about anything we've talked about today or mortgages more broadly, we would absolutely love to hear from you. Our phone number in the office is 0345 345 6788. By all means, send us an email, have a look at our website. There's lots and lots of really great information on there as well. But one way or the other, we're always there to have a conversation with you and try and help you out. Thank you again for your time, and we will look forward to catching you at the next MFB Live.